The stock market is often the first thing that comes to mind for investors when they think of financial markets. However, the bond market is the larger, less showy equivalent of the equities market. When it comes to capital markets, the bond market is much greater than the equities market, which is often discussed as the largest market. US Treasury bonds, one of the safest assets in the world, are at its core. Treasury bonds have been offering some of the best yields in decades as interest rates have climbed in recent years. In the area of US fixed income, the US Treasury market is a sizable market that offers a better yield than it has in the previous 20 years. Compared to 12, 18, and 24 months ago, the yield levels and income opportunities are much more intriguing and alluring now. We are accustomed to extremely low yields both internationally and in the US. The US economy may be significantly impacted by the recent change in US Treasury buyers. The last several years have shown a decreasing desire for US government debt, which is highly rare. Compared to all the other nations, the US sort of stuck out for being so reliant on foreign capital. Japan and China have both retreated from being buyers. Over an extended period, China and Japan have not been significant purchasers. I believe that because the Treasury market was a market for foreign investors or the Fed, we have not given it much attention. It's a market now that benefits all of us and offers a higher payout for you. Therefore, we shouldn't disregard it. Why then are significant purchasers avoiding the Treasury market? What effect does this have on yields and the overall economy? And what is the best way for investors to move about the market going forward? The $26.5 trillion market for US Treasury bonds. So the US bond market as a whole is doing well. It consists of corporate, mortgage, and US government bonds. One important one is Treasuries, which are essentially debts issued by the federal government to meet its operating expenses. The Bloomberg Aggregate Bond Index, which analyzes the performance of US investment-grade bonds and is often seen as representing the bond market as a whole, indicates that the US Treasury market makes up about half of the bond market. US Treasury securities make up more than 42% of the index. Because of this, I almost see the Treasury market as the benchmark bond market, where all other corporate bonds are traded. This establishes the standard for all other bond market investments as a kind of risk-free rate. As a result of the US government's guarantee, the bonds are regarded as extremely safe investments. You will receive your investment back if you invest $1 in Treasury bonds. The Federal Reserve can indirectly influence the market by influencing the Fed funds rate or short-term borrowing rates, even if they have no direct influence on Treasury yield levels. Another thing that we have observed over the last year and a half or so is that the Treasury market has generally responded in kind when the Fed has lifted its benchmark borrowing rates, say by a quarter point or half a point. Bond investors typically respond with, okay, we want more yield as well, when the Fed hikes. Purchasers of US Treasury bonds can typically be, or the purchasers, divided into two subcategories, international and domestic. One major domestic buyer of Treasury bonds is the Federal Reserve, which makes up a significant portion of the market. A year ago, the Fed was a significant purchaser. However, the Federal Reserve acts as a buyer when it implements quantitative easing or QE. In addition to banks that purchase Treasury bonds, there are real money investors, insurance firms, pension funds, and money market funds. Additionally, we observe strong demand for Treasury bonds from several international nations. China and Japan are two of the biggest holders of Treasury bonds. One large group of buyers is foreign investors. Even if the consumer base is far smaller now than it was 10 or 15 years ago, demand from it is still strong. Historically, the belief has been that there is always a demand for Treasury securities because they are highly sought after by both domestic and foreign investors. However, that theory was tested at the end of last year when we witnessed the spike in Treasury supply, which was caused by an increase in the issue of both bills and coupons. Buyers switching. Over the past few years, the last few years, foreign demand for Treasuries has decreased dramatically, primarily after COVID-19. The Federal Reserve and other more established buyers of Treasury securities, such as foreign governments in general, have seen a significant decline in interest in Treasury securities. Global central banks, especially those in China and Japan, are major purchasers of US debt. They have retreated, especially China, which has retreated very significantly. For the first time in a long while, their holdings are currently worth less than $1 trillion. Even though they are currently the top two foreign holders of US Treasury bonds, China and Japan have seen a fall in their respective holdings recently, coinciding with the Federal Reserve's decision to start hiking interest rates in March 2022. Japan, for instance, has always been a very big buyer of US Treasury bonds. By purchasing US Treasury bonds for an extended period, they were able to obtain a significantly higher yield than they might have at home. Lately, that has been eroding because my liabilities are in yen if I am a life insurance firm in Japan. Because my payment is done in yen, even if I make a lot of money on my treasury position, I will still need to hedge it back to yen. The last 6 months have seen a significant increase in their currency-adjusted treasury purchase costs. The Fed, which was attempting to stimulate the economy with QE, was one of 2 other significant buyers that surfaced in recent years. QE has ended then. In actuality, we're experiencing quantitative tightening. The Fed is not buying then. In actuality, they're allowing their portfolio to decrease. The amount of US Treasury holdings is still relatively high, but they aren't purchasing as frequently. Banks was the other one. Since COVID-19, domestic banks have been large purchasers of Treasury bonds because of the notable increase in deposits and the decline in lending demand. The Treasury has been dependent on other market players to intervene and remove that extra supply. And so US domestic investors are the new marginal buyers. And who is that? Households, insurance, pensions, and mutual funds. They have also been making up some of the lost ground as these, foreign purchasers in demand have been leaving. Therefore, people who would have purchased Treasury bonds naturally, that is, without necessarily anticipating portfolio success, have long since vanished from my memory. As we witness a shift in the direction of these more domestic investors, whether they be hedge funds, mutual funds, individual investors, or something else entirely, we're finding that they're far more sensitive to price fluctuations. Simply said, they're not quite as sticky. Thus, looking forward, we would anticipate a little bit more volatility here. You examine the Treasury market for this reason. We're now making progress even in the absence of any Fed action. For the past 6 months, the Fed has not increased or decreased interest rates. Nevertheless, the 10-year changes by 7 to 8 basis points per day. In addition, there is the notion of a term premium, which refers to the more income that investors desire in exchange for keeping longer-term securities. Investors demand payment to eliminate the excess supply. That has been a major factor in the increase in Treasury yields thus far. At one time, the 10-year yield even crossed the 5% mark. Increased Treasury yields, especially the yield on the 10-year note, may have repercussions for the overall economy. In particular, mortgage rates are said to be directly impacted by the 10 years. Mortgage rates typically increase in lockstep with increases in the 10-year yield. Interest rates are established with this in mind. The corporate rate will always be higher and the mortgage rate will always be higher than that. For example, mortgage rates were above 8% when the 10-year yield was nearly 5%. For this reason, we refer to it as the benchmark 10-year period. It should be noted that markets, lenders, banks, and the like position many of their other rates incorrectly. We just don't have enough buyers of the 10-year within the US domestic market. So you can envision a scenario where the Fed cuts rates to 3% and the 10-year is still at 4%. The stock market may also be impacted by rising Treasury yields. If, for instance, the yield on the Treasury's 10-year bond or the risk-free rate is exceptionally high, and you as an investor believe that all you need is a 5% return on your investments, guess what though? At that point, you'll most likely just invest it in Treasury yields. In summary, I believe a lot of things need to in a certain way for the 4% investment to be a negative one for the next 10 years. There's still a lot of room and carry, but you missed a little bit of that. There are many worthwhile options available if you were to purchase the 10-year here, especially when considering things from a medium to long-term standpoint. All things considered, this is a compelling entry point. Thanks for watching. Don't forget to like, subscribe, and hit the bell icon to stay updated with our latest content. See you in the next video.